Every empire has its hidden vaults, not of gold or jewels but of silence. And inside those vaults, power moves unseen. While the world sleeps, a quiet financial storm brews beneath Manhattan. Not in the trading pits or the skyscrapers, but deep inside the Federal Reserve Bank of New York. There, trillions of dollars change hands every single night in a ritual few understand and even fewer dare to question. Welcome to the world of the Reverse Repo Facility, the most misunderstood engine in global finance. It's not a conspiracy. It's not a secret gold chamber. It's a mechanism so obscure that even seasoned Wall Street traders stumble when asked to explain it. Yet it quietly holds more than $2 trillion in cash, money that seems to exist but doesn't move. If you enjoy uncovering the hidden machinery of the global economy, the parts that silently shape your paycheck, your mortgage, and your nation's debt, make sure to subscribe and like this video. Now, let's pull back the curtain on one of the strangest monetary mysteries of our time. To understand what's happening, we first need to decode what a repo actually is, short for repurchase agreement. Think of it as a pawn shop for banks and funds. One party, usually a money market fund, lends cash overnight to another, often the Fed or a large financial institution, in exchange for collateral like US Treasuries. The next day that collateral is repurchased at a slightly higher price. That tiny difference is the yield, the price of safety in the world's biggest cash marketplace. It's the plumbing that keeps global finance from seizing up. But what happens when the system flips, when everyone wants to lend and no one wants to borrow? That's when the reverse repo steps in. In this case, the roles switch. The Fed borrows cash overnight from private institutions and offers treasuries as collateral. At first glance, it sounds harmless, just another nightly shuffle of money between giants. But look closer. By 2023-2024, the Reverse Repo Facility had swollen beyond $2 trillion. That's $2 trillion parked at the Fed, collecting interest, doing nothing. It's as if every player in the financial game suddenly decided to sit out the next round. So, how did we reach this bizarre point? It began during the pandemic when the Federal Reserve unleashed the largest wave of quantitative easing in modern history, printing money to buy treasuries, mortgage-backed securities, and bonds. Liquidity flooded the system like a tidal wave. Suddenly, money market funds were drowning in cash with nowhere to go. Yields on short-term treasuries and commercial paper fell to near zero, or even negative after inflation. The Fed's solution? Open the reverse repo window wide. It invited institutions to park their excess cash overnight, paying them a small yield, the RRP rate. What was meant to be a temporary safety valve became a black hole. By mid-2023, nearly every major money market fund in America had joined in. Pension funds, mutual funds, even foreign central banks piled into the Fed's vault. The result? Trillions of dollars permanently sidelined. But as the Fed soaked up that cash, it began another mission, raising interest rates at the fastest pace in 40 years to fight inflation. And here's the irony. The Fed suddenly had to pay billions in interest on all the money it was holding. The same central bank that once created money from nothing was now hemorrhaging it just to keep the system stable. Yet that's only half the story. The real danger is invisible. When that much money sits still at the Fed, it stops circulating through the economy. It's like removing $2 trillion from the bloodstream of global finance. Liquidity freezes. Banks, already cautious after years of new regulations, lend less. The repo markets thin out. And even as inflation appeared to cool, parts of the financial system began showing signs of deflationary stress. The quiet disappearance of liquidity where it's needed most. Bond markets trembled. Treasury auctions struggled to find steady buyers. The once vibrant plumbing of global finance began to echo with emptiness. Analysts gave it a name, the reverse repo trap, a world where too much safety creates danger. Imagine an engine flooded with fuel. Instead of roaring forward, it chokes. That's the reverse repo crisis in a nutshell. Why, then, would institutions rather park trillions with the Fed than lend it into the real economy? The answer lies in fear. After waves of bank failures, market shocks, and geopolitical tremors, big players simply don't trust each other. Parking money at the Fed is perfectly safe. Lending it? That's risk. And so, the system devours itself. In a healthy economy, excess cash eventually finds its way back into lending, fueling business expansion, infrastructure, and innovation. But today that flow is jammed. The Fed, intentionally or not, is now competing with the private sector for capital and winning. Every dollar sitting in the reverse repo facility is a dollar that isn't building, hiring, or investing. Some economists call this the silent tightening, an invisible form of monetary contraction that doesn't make headlines but quietly squeezes growth. Beneath the technical jargon lies a deeper truth. This crisis isn't just about liquidity. It's psychological. Fear of volatility. Fear of regulation. Fear of loss. In an age of uncertainty, from inflation to war, the reverse repo has become the ultimate comfort blanket. But that comfort comes with a cost. Those trillions sitting idle aren't harmless. They represent frozen potential, unrealized growth, and a system too scared to move forward. And if history has taught us anything, when money stops moving, economies start breaking. At first glance, the reverse repo seems like a triumph of prudence, a safe harbor for institutions, a stabilizer for short-term rates, a tool of monetary control. But beneath that calm surface lies the same irony that has haunted financial systems for centuries. The pursuit of safety often breeds instability. So ask yourself, what happens when everyone wants safety at the same time? In a normal economy, cash is the grease that keeps everything turning, from small businesses to global credit markets. But when trillions are trapped inside the Fed's vault, that grease turns to glue. Liquidity, the lifeblood of finance, stagnates. The Fed, trying to fight inflation by raising rates, unintentionally builds a dam that blocks the river of money. Picture it, the economy as a river, the reverse repo as the dam. At first, it prevents floods, stabilizing markets. But as more and more water piles up behind it, the reservoir swells while the fields downstream, the real economy, begin to dry out. Now multiply that dam by $2 trillion. Here's where the irony turns expensive. Each night, when trillions flow into the reverse repo facility, the Fed is essentially borrowing from the private sector and paying around 5.3% interest. On $2 trillion, that's over $100 billion per year, paid directly to the financial giants: BlackRock, Vanguard, JP Morgan's money funds. And who ultimately bears the cost? The answer is simple: you do. The Federal Reserve doesn't conjure profits from thin air. When it pays interest on those reverse repos, it reduces its own earnings, which normally flow to the US Treasury. Less Fed profit means less revenue for the government. In the end, the system's search for safety becomes everyone's silent expense. By 2023, something unprecedented happened. The Federal Reserve posted negative income for the first time in decades. The reason wasn't failed bets or bad loans, but the cost of paying interest on trillions parked in the reverse repo facility. In short, taxpayer money began quietly subsidizing Wall Street's search for safety. But the real problem isn't financial, it's psychological. The more institutions rely on this facility, the more addicted they become. What began as an emergency tool has turned into a permanent fixture, a risk-free yield machine built into the system. Why lend to small businesses or buy corporate bonds when you can earn guaranteed returns from the Fed? This is financial repression in disguise. Capital hides in safe assets instead of fueling innovation. Growth slows, wages stagnate, and risk aversion spreads like a virus. Ironically, that fear breeds instability. The reverse repo has become a shadow central bank, shaping liquidity through quiet incentives rather than open policy. It gets darker. The Fed created this system after 2008 to give money market funds a safe place to invest. But by paying them interest, the Fed now competes directly with the US Treasury. Both borrow from the same pool of investors. When the Fed's short-term rate looks more attractive, money leaves Treasury bills and flows into the Fed instead. The result? Treasury auctions show weak demand, dealers are forced to buy leftovers, and government borrowing costs rise, while trillions sit idle in the Fed's vault. It's absurd. The very institution meant to support the Treasury is now crowding it out. Few people even know this exists. It hides in the Fed's balance sheet, quietly steering global liquidity. Yet for those who do, the reverse repo is a warning signal, proof that too much cash is chasing too little productivity. Markets thrive on balance, but when everyone seeks safety, there are no risk takers left. And when that fear flips, when institutions start pulling money out all at once, the dam bursts. If trillions rush out, we enter uncharted territory. The same mechanism that drained liquidity could suddenly unleash it in a flood. Rates could swing violently, Treasury yields spike or crash, and banks scramble for collateral, just as in 2019 and 2008. Because the reverse repo isn't just holding cash, it's storing pressure. And when that pressure releases, it won't stay hidden for long. The facility was never meant to be permanent. But over time it became part of the plumbing. Every major fund, corporation, and global bank now relies on it. So when those trillions move, say when Treasury yields rise, it won't be a trickle. It'll be a shockwave. $1 trillion shifting overnight from the Fed into Treasury bills might look harmless, but in practice it destabilizes everything. We've seen it before. In September 2019, repo rates jumped from 2% to 10% in a day. That crisis forced the Fed to inject hundreds of billions overnight. Now the system is 10 times larger. Any sudden unwinding could dwarf 2019's shock. By early 2024, usage of the reverse repo dropped from over $2 trillion to under $700 billion as the Treasury issued more short-term debt. On the surface, good news. But it revealed how fragile the system is. Each tiny yield shift triggered massive outflows and market tremors. If money leaves too fast, rates collapse, undermining the Fed's inflation fight. If it leaves too slowly, the Treasury can't sell its bonds. There's no smooth exit. The Fed is trapped in the reverse repo paradox. Move too fast, liquidity floods. Move too slow, the economy starves. And the irony deepens: the more control the Fed tries to exert, the less it actually has. This isn't just an American issue. The global system is tied to the US repo market. A liquidity shift in New York ripples through London, Singapore, and Tokyo. When reverse repo usage plunged in late 2023, the yen and yuan wobbled as dollar liquidity tightened. Investors moved defensively, bracing for invisible shocks. For most people this feels abstract, but it's not. When liquidity drains or floods, mortgage rates rise, corporate borrowing costs jump, and pensions lose balance. You might not know the term reverse repo, but it's shaping your paycheck and rent right now. We live in an era of engineered confidence, stability built on control, not trust. Central banks replaced organic resilience with artificial balance. But control has limits. The more dependent a system becomes, the more fragile it grows. When trust breaks, the same tools meant to save it amplify the collapse. The reverse repo won't prevent the next crisis, it might trigger it. It doesn't build homes or fund innovation. It freezes motion and calls it stability. Every dollar parked at the Fed is a dollar not building, lending, or creating. That's why post-pandemic growth feels hollow. Asset prices soared, profits exploded, yet wages lagged, small businesses suffocated, and inequality deepened. Liquidity was created, but it never reached Main Street. It stayed trapped between the Fed and the financial elite. On paper, the system looks fine, yields stable, rates controlled. But beneath the surface, the velocity of money keeps falling, draining opportunity from everyone else. And trust, once the foundation of markets, now rests on a single institution. Markets no longer trust each other, they trust the federal. Until the day they don't. One technical glitch, one cyber attack, one policy mistake, and trillions could freeze overnight. As finance merges with technology, the line between cash, credit, and code blurs. The reverse repo, the Fed's balance sheet, and digital currencies are all steps toward programmable liquidity, a system where flows can be turned on or off at will. That's not stability. That's control. When every dollar is traceable, control of money becomes control of behavior. Who gets liquidity, when, and under what conditions? That's real power. The reverse repo is the prototype for this world. A financial system run by switches, not trust. And here's what it means for you. Volatility is structural now. Markets no longer move with business cycles but with policy cycles. Every shift in the Fed's strategy ripples through stocks, bonds, and real estate alike. Diversification is harder, and safe havens barely exist. Savers keep losing. Facilities like the reverse repo hold rates down and assets up, a silent wealth transfer from savers to borrowers. Independence, financial or otherwise, grows harder to maintain in a centralized system. But knowledge is protection. Understanding how liquidity moves is the first step to defending your future. The danger isn't the reverse repo itself, it's believing it doesn't affect you. Because it already does. Every mortgage, paycheck, and investment is tied to this hidden machine beneath the economy. The Fed may appear to balance it all, but no institution can outsmart its own complexity forever. Systems built on confidence, not collateral, always break faster than we expect. The reverse repo isn't just a financial mechanism, it's a mirror reflecting how we've mistaken stability for safety and control for wisdom. It's not a story about trillions in idle cash. It's a warning about a system that's forgotten how to trust.